In this video, traders, we are going to look at why looking at price this way is a huge mistake. Stay tuned. Hey guys, warm welcome to you. Thank you so much for joining me. As always, I'm very delighted to have you here and I appreciate you joining me. Okay, so this is a big mistake. I've fallen into this trap many times in my early years as a trader, and I see traders falling into the same trap again. And that is just looking at price without any other context. So I want to give you two examples here. And actually, this kind of thing happened the other day. So imagine you've got a level that you're interested in getting long at, and it's $35 or 35,000 on the Dow or whatever it may be. Okay, you've got a price level here. And you're saying, you know what? I'd like to get long at that level because it matches in with my daily idea, matches in with my trade thesis. I'm just looking to take this trade, bounce back up, whatever it may be. Now you might think, okay, well I could just set a limit in there and I want to get filled at 35. But you've got to think more strategically than that. I think that's an error. Now I know some people are like, fine, I'll just do that. And it does depend on your time frame. It depends on a few little nuances to it. But I think that's an error. Let me tell you why. Because if you imagine these two charts, okay, in both these scenarios, prices hit 35. Imagine it's an intraday chart. And so you've got the open here, you've got the close here, there's your kind of trading session, and maybe it's a stock, maybe it's an index, it's actually the cash session of the index, or whatever it may be. So you've got now two different scenarios. A scenario here, market opens, dips down, does a little double bottom at 35 in the morning, and that's when it hits 35. Let's forget about what's happened after that for now. Versus market's gone up way, left that 35 behind, but actually has reversed quite heavily and tags it just before the close. These are two very distinct different ways where price has tagged that $35 level. Completely different. If I wanted to buy at 35, I would look to buy that. I'd be like, okay, I want to buy at 35. I think it's a good level to buy it, blah, blah, for whatever reasons. I like a little kiss down in the morning and a rally into the close. If we were smashing down and everyone was panicking, running for the door and it was hitting 35, I'm not going to stand in front of a freight trade. Now, that might be someone's strategy. Someone might, okay, I might want to do that. But for me, we've seen that the precursor for how prices got there has changed dramatically. This is a case of probed higher, probed lower, double bottomed around my area, started to pick back up. It's around the right time of day. It's got plenty of hours left in the day to rally, etc., etc., etc. Versus, hey, I've missed it. Well, everyone now is trapped in this massive rally that's just literally undone everything and slammed through the floor. And actually, this happened very similar on the Dow not long ago. My thesis was, hey, I want to buy one more little dip at the open. If we get a dip at the open, I'll pick it up at that level, scale some out as we push back to the open, and then look to trade it as it continues higher. But it didn't. It rallied straight off. And then the last hour of the day, it was right down and it done a huge reversal, just selling. There's no way I want that. I want to let that resolve and refresh what level I'm looking at to go long if I still want to get long. So it's the big mistake that I think that it's a trap I think everyone falls into, or not everyone, but a lot of people fall into, is we say that's the price is the price and it doesn't matter how it gets there. Now, to a certain extent, I'll accept there's an argument that I'm not right with my thinking. I'll accept there is a few times when you can say, well, actually, I want that price and that's it, and around how it get there. Perhaps if you're swing trading, I'll give you that. If you're swing trading, maybe like, okay, it's slightly different. But for day trading, I do think that it's very important to understand the time of day you're operating in. We've got the open, we've got the mid-session, we've got the close. If price is falling through the floor at the close after having rallied hard, then the chance of it continuing lower is probably quite a lot. And that's not really what you want. You don't want it to be falling through the floor. You want it to be holding and have that rotational level. Now, okay, there's an argument to say, well, I might just catch an exhaustion, it pops back up, but that's a different trade. It may be the same price, but it's a different trade. If you're looking for an exhaustions as well, guys, exhaustion, going topic here, but exhaustions are very much based on a price action, an actual pop lower, pull back, big bar, big volume. Judging where that price is very hard. Now you can say, well, I'll take it below a level because that would flush everyone out. Maybe below a prior low, if I see exhaustion below the prior low. But you don't know how far it's going to go below the prior low. You don't know how far it's going to go below your price. So it's very hard to sometimes judge exhaustions based on price versus, okay, I think if we're a rotational market, we come down to my level. And I'll see if we double bottom, if we reverse, if we do that. It's a slightly subtle way, a subtle distinction between this and that. So looking at price this way, I think, is a mistake. I think looking at it in this context, in terms of where you are in the trading day, how the price has got to it makes a lot more difference. It does to me anyway, but maybe for you it's not. But maybe it's something you can look at. Maybe you can go, okay, well actually, how long have I kept an idea too long? If my idea is to buy at 35 and I've still kept the idea right to the end of the day, when actually the situation's changed, the narrative's changed, the dynamic of price has changed, we've now gone up and rejected, do I still want it? Do I still want it versus just dipping at the low? Maybe you do, but maybe taking a little bit more stock of how price got there might just make you say, okay, well, perhaps I don't want it at 35. Maybe I still want to buy it. Maybe I just want to see where this ends. Maybe I want to see if it flushes first. Maybe I want to see if it comes back down, then comes back up through 35. You can still buy 35. Maybe it comes back down first, then comes back up through that key level. So little subtle different ways of getting on board the trade rather than just standing in front of it and saying, well, it's the same 35 as it was this morning. I don't think it is. So anyway, have a look at that, guys. Maybe it's something, a little tweak, a little adjustment you can make that might help you improve your trading. Take care. See you next one. Bye-bye.